Welcome back, yield nerds. This video is in somewhat of a rapid succession with respect to the previous one, and there is a reason for it. The market has started to react to the debt crisis that is looming probably in another less than 3 months. And so I thought I would share my education on what kind of strategy that I'm putting in place, and you do your thing based on that. And I'd love to hear your feedback as well. So I'm going to lay out a three-part strategy to prepare for the debt crisis in July 2023. Couple of quick notes to new subscribers. There is a video by the title How to Navigate the Channel that tells you how this is organized. There is a playlist that walks you sequentially through it so you don't have to jump in the middle of a topic. So please keep that in mind. My usual disclaimers: this is not investment advice. I am not a wealth management advisor. I do not have a secret agenda. This is not politics. I'm sharing my education, and I look forward to your comments and feedback. All right, let's walk through how this particular episode itself is organized. We're going to look at what the backdrop is and how the markets are reacting and anticipating what could be and would be in another couple, 3 months. And then I thought I would share how the market reacted, or how the Fed reacted and the government reacted when there was a banking crisis. Because at the end of the day, there is a government interest in terms of keeping the country stable. And so we'll look at some of the lessons from how the banking crisis evolved and take a quick stab at what we think it means for D-Day or default day, if and when it comes, and what you and I can possibly do for the next 85 days. And I'll share with you how I'm thinking, and I'd love to hear your feedback. Well, big news. This article is from earlier today or yesterday. The treasury market is starting to price in the possibility of a default in July. Now, why is that important? The reason being, there isn't just one person or two people who are talking about the worst case scenario. It's no longer that the large institutional traders are expecting volatility. And what does that mean in terms of short-term bond prices? So to do that, we're going to dive deeper into just the 1 month and the 3 month. And this is from white charts, and you can see the source there. Look at what has happened just in April. There is a meteoric decline from about 4.5 something percent for the 1 month bill to 3.4%. That is a 33% drop in prices, which is pretty stunning. What does that mean? It means that when the government goes out to auction 1 month bills, they will give it to the lowest bidder, and there are people, or there are institutions who are willing to accept a lower and lower price because they would rather own the 1 month. And then you have to say, instead of what? And to answer that, you should see where prices are sticking. That is where the government has to pay a premium to get the buyer to accept their debt. Clearly, in the 1 month, the government is able to get a much better deal. And to answer that question, it's pretty easy. If you look at 3 month bills, which mature kind of sort of in the July timeframe, there is really no dip. And you can see that this blip that happened here, where rates sharply decreased, was when the theory was that, ooh, inflation is going down, and all problems known to mankind have been solved, which obviously was a joke. And so once it was established that the inflation wasn't really going down and we haven't turned the corner, the 3 month rates shot up again past 5.1, and it's staying there. And especially the July bill, the volume or the price at which it is being accepted is much, much lower. There is quantitative tightening. So there is a signal being sent that, hey, we're uncertain about July, which I find very interesting and very consistent with what we've been saying before. So what is the implication? So let's think through this step by step. If you gave Uncle Sam $988.50 today, April 21st, and you said, I'll take it back from you on July 21st, but I want $1,000. That's give or take 85 days. And you would then, in that scenario, make a yield to maturity of 5.1%. And you can go to this website here or any yield to maturity calculator and say, I give you 988.5, you give me back 1,000. 0.2328 is really 85 divided by 365, and it says you made 5.1. That's kind of sort of what is happening in the market. So that's the normal. What if Uncle Sam said, hey, I print cash in this printer. I got a printer jam, which in effect is what is happening. The printer doesn't have new paper being fed because there is a debt crisis. So Uncle Sam says, I can't really print cash. Can you wait a couple of weeks? I told you I'd give you back the money on July 15th. I don't know if I can do that. What does that mean to you? Suppose the government said, we're not able to give it to you on July 15th, but we're going to give it to you on July 30th. What do you think will happen to that 5.1%? Where do you think that will end up? The answer is 4.27%. The reason the yield is so high, the difference is so high, is because the term of the yield, term of the bond itself is only 90 days. 15 days to a 90-day bond maturity, bond duration is a big, big number. And so you would lose 12% of the yield if the government only returned your money on July 31st instead of July 15th. Now, that's the least of the problems. If the government cannot pay, the roof would shake in so many other areas. We really don't want to be here. But if the two parties cannot agree on how to extend the debt ceiling crisis, how to extend our borrowing capacity, then if there is a discussion past the D-Day, which we don't know whether it's July 15th, just a 15-day extension would cause things to crater around the world. What happens if it takes 30 days? And I'm just giving you a scenario so you can understand. If you gave 988.5 today, and Uncle Sam said, I'll give you back 1,000, but instead of 85 days, I'm going to take 115 days. Your yield to maturity would fall substantially. It would fall by 26%. So these aren't ordinary shocks. For the US government to be frozen and unable to pay its debts for 30 days would be unheard of. And I would imagine both parties would have come together by that time. But this is what tells you what the market is starting to price in. The market is saying, I don't want to touch that with a 10-foot pole. I'll just keep buying the 30-day, and I'm not even going to touch the 90-day. But let's look at what happened during the banking crisis. The US government stepped in and said, forget about the, $250,000 limit, the FDIC, any of that. We're just going to guarantee your deposits no matter what it is. And even though there were two parties and they can't agree on anything, there was some level of criticism from the sideline, but largely everybody understood that the US banking system is essential for the currency and we can't just let it crash and burn. And so they made sure that this thing happened. So this is on the banking system bailout for Silicon Valley Bank. Same happens for Signature Bank. We just cannot let these large institutions crash and burn. And so here is the lesson that I take from it. Whether the default is 0 days, and I really, really hope that is the case and that there is no default, or it's 15 days or 30 days, there is no doubt that the holder of the debt, you, the buyer of treasuries, there is no doubt that you're going to get your money back. You may get your money back on the maturity date, 15 days later, 30 days later. And if you were to take a lesson from the banking crisis, in all likelihood, the government will come back and say, hey, I screwed up here. Instead of paying on 90 days, I paid you 105 days later, and I'm going to make good. I'm going to go ahead and give you the delta, the interest, as though the bond actually matured on a later date. There's always that possibility. It just doesn't appear that the country would take its lenders, for granted. And so my guess is that if it goes past the duration at all, there would be amends made, very much like the banking crisis had its own amends made. So what does this mean for you and I? I have a thesis. I'd love to hear your comments. My thesis is that at the last minute, or maybe an hour past the last minute, both parties will come together and say, we cannot torpedo the US currency. We're just going to avert it. This may happen a little bit into the D-Day window because there's always theater and people, get to take credit. Unfortunately, that is politics. However, the path to that will create huge ripples in the equity market. And that means yield investors like you and I will sit there and say, I got a nice, reliable dividend stock, and now the enterprise value drops. I'm going to go grab it. The third thing that would happen, and we've studied, and if you want to look at some of the previous episodes, you will see that we looked at what happens to the price of certain commodities. And I'll give you a hint. What happens to the price of rock salt? What happens to the price of coal? What happens to the price? So there are a few things we reviewed earlier in past recessions to see that certain things did not get affected by recession. So you may want to look at what those are, what kind of things inflate in a recession, and then unfortunately, if there is a currency blip, it would cause an immediate inflation, and then it would cause a market crash. I mean, this would not be a good thing at all, but you kind of want to be on the smarter end, prepare and say, what are those commodities that actually benefit from being the security blanket in such a scenario? And so here is my plan. You have your own plan. I was going to take about a third of my yield investment amount and bet on both parties coming together before July 15th or on the nose on July 15th and averting the crisis. That's a third of my bet. 60% of the bonds that I have maturing, 60% of the monetary value of the bonds I have maturing between now and June 15th, I'm just going to keep putting it in extremely short term. It could be in the secondary market for 5 weeks, 6 weeks, whatever it is, but sit in cash on June 15th. The reason I say June 15th and July 15th is you don't know, and I don't know what that exact date is. But as April goes through and as May comes through, the volume at which the government is going to start communicating will go up. The government will say, hey, we got 2 weeks of cash, we got 4 weeks of cash. And so you will have a good idea of when that date is, and you don't want to cross that duration with the bulk of your yield assets. Obviously, what I plan to do is stick some of this right on the nose, because if the current is any indication, the price of those bonds that mature right on the deadline will crash, and that means you will get a really nice yield. And so about a third of my investments will go right on the twilight zone. 60% will be in cash, so I can sit there and look for nice value stocks, dividend paying stocks that have a good track record, low PE and so on. And the last part is sit there and say, what are debt-free companies with high cash flow, low PE, and things you cannot live without during an inflation, and nibble at them even starting now. And there are some very rare animals right now that you can buy. As May and June come, that list may be even bigger. So that is my plan. I would love to hear what you think, and this kind of hedges our bet. If there is no crisis, then your bonds will mature. You'll get a really high yield as indicated right now. If there is a crisis, you will have a high cash balance. And leading up to the crisis, you will also have a pot of equities that you think will ride through the crisis and come out on the top. That is my thesis. The ice cream, the proverbial ice cream we talk about, which is nice, juicy, short-term yields, is under threat. The three-part strategy, therefore, is to sit here and watch what the audible is between now and June 1st. I would not add duration. You do what you want to do. I would not add anything discretionary in terms of equities, because that would be asking for trouble. If you have any questions, any comments, I'm happy to share my thoughts. I would love to hear your thoughts as well. yieldnerd@gmail.com. Thank you. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.